This is episode 1 of the Market Podcast, so let's get into it. Now, yesterday's session was a volatile session. Wall Street finished lower on Fed's monetary policy decision day. The US Central Bank raised rates as expected by 25 basis points. The end of the tightening cycle is near as the Federal Reserve balances between elevated inflation and banking turmoil. Stocks jumped off the announcement but then they pulled back, making a reversal helped by US Treasury Secretary Janet Yellen's comments. She said they are not considering blanket insurance of bank deposits. So, a few things that are sort of on investors' minds at the moment is a stock market crash due to the banking and the deposit rates. Then the FTSE falling. They gave a lot of people the sleepless nights. And the US stock market moved higher Wednesday after the Federal Reserve raised interest rates by 0.25 percentage points amid a fast-moving bank crisis. But if you take a look at the charts, you will have seen that the US 30 at least ended the day lower towards the end of the session. Now, what's going on today is we've got the Bank of England going on. We've got a few other things at play too. So there is quite a few things happening today. Now, don't forget, shall we say, to remember that this is the first episode of the podcast, so this is nearly here as a way to test out and for us to learn how to progress the format of the podcast. Now, if we move to some of the things hitting the market, you've got to remember that at the moment we are playing with a high inflation. And we have got a few things worrying in the background of things too, more risk-off sentiment. So the risk-off things at the moment are simply as follows. You've got the high inflation, which is of course caused by the back of the COVID and the Ukraine-Russia war, which isn't helping as some of the supply strains are still continuing to be a problem. You've also then got the balancing act of where to go here. So the central banks are obviously deciding how to push forward and how to manage the monetary supply problems, try and curb that sort of inflationary problem that we're starting to see. But if you look at some of the banking reports, you can sort of see that we are starting to turn into a stagflation area, which is the main things. You get inflation, stagflation, then deflation as the inflation starts coming down to the central bank target. What you've got to remember is a lot of things are a lagging indicator of metrics. So you look at how the central banks are starting to play. They're using information that's 3 to 6 months old. They're ahead of the inflation curve rather than before it because they can't make rash decisions. They've got to make sure that any decision they make is going to be the right decision, even though that's easier said than done with an ever-moving market. So what might seem incorrect today might actually help within the future as the money markets ties it. You obviously have to remember is that a lot of import and exports are out due to the costing of moving them said goods. So a few things like, for instance, the export of corn, oil, petroleum, diesel, etc. and so on. As costs go up, the costs get passed. So if you look at a supply chain line, for instance, the costs get passed over to each member of that supply chain line, which then, of course, the main consumer apparently ends up eating all the costs, even though everyone on the way is have to endure them costs ever so much. So yes, it does end up being more expensive to the end consumer, but it is also more expensive for everyone else in that line too. Now, and you might think, well, why don't we export more? But that's not up to a simple thing. You've got to remember OPEC Plus determines the sort of input and output rate of the barrels per day. But then you got to remember is America can do the same too, and some other countries as well. But if they're part of the OPEC, then it tends to be a unified thing. Thing you got to remember is just the big general cost of things have gone up because we're past COVID. There's new technologies getting invented, there's new businesses being created, there's new products being advertised, people's habits have changed. So before COVID, everyone wanted avocados. Now everyone wants eggs and tomatoes. So it all depends on what product it is being wanted at that time. Then you look forward and we start to see the whole Ukraine and Russia boiling grit. A lot of people, panic buying. A lot of trade routes are open. Companies are using the materials to create weapons, other tools, etc. and so on. So that pulls a lot of material from their consumer sectors, as they have called. Then that affects that. Now, if you've been keeping up with the US and the Ukraine, etc. and so on, then you'll have noticed that China and Russia are starting to get friendly now. This could be a blessing in disguise. Granted, it's not two countries you want to be friends, but if China sweeps in and be's the hero and gets Putin to back off Ukraine, or they come to some sort of peace treaty, then that's better for everyone in the long run. And China's trying to become a highly domesticated market to compete against America, to try and knock America off that number one spot. So it's just the global game of chess, as we've called it a few times. Moving on, over the course of the next year, of course, you've got things like the war could be ending, it could be escalating. You've also got the rural banks, so Fiji collapsed. Credit Suisse has been bought by UBS, but do remember that deal might not go through fully until the end of the year. So a lot of Credit Suisse employees have been told not to speak to UBS because they are still a competitor. And then you've got First Republic and a bunch of other banks, but you've got to remember is the majority of banks that are going under. It's not like the Lehman Brothers of 2008-09. It is more so the banks that have tried to run before they can walk, starting to get hurt when most of these banks aren't really not used. Of course, the majority of them are American, so if you're an American, you most likely know more about them banks per se. But according, when you look at the bank sector itself, the main ones, JP Bank of America, Barclays, NatWest, Santander, etc. and so on, are the main banks that people tend to choose rather than these other banks. So the bank run is, of course, a bank run, but it's not. If it was one of the big banks like JP Morgan, people would care a lot more. Now, of course, most of the banks are buying these smaller banks, so when the bigger banks are able to buy the smaller banks, that's kind of an indication that, well, yes, it is a brand bank, but it's sort of, kind of the same as, well, not the same, but very similar to how it was when there was that run on Kodak and GME pack a few years ago, or a year ago, shall I say. So it's just a squeeze on the banking sector. The companies weren't going to survive anyways, and now they're just being squeezed out of that industry. So take that with a pinch of salt and take it how you'd like. Now, a few of the comments and things before I end this episode is that the risk on risk off market sentiment at the moment is sort of in the middle. Everything's ranging. Everyone's kind of waiting to see where the world is going to go rather than trying to predict it. There is, as you know, a lot of geopolitical tension going on, a lot of back and forth. Everyone's wanting to know what central banks are doing. Everyone is pretty much playing the guessing game at the moment. So until there is something definitive that comes out, until there is reports, etc. and so on, where people go, this is what's happened, this is what's going on, then there is going to be a lot unstabilized market movement at the moment. So that is it for episode 1. Don't forget that you can go and say hello in our Discord, which is in the information part of the podcast. This is just the first episode, like I mentioned before, so the format, everything will be changing, but it would be nice to hear some of your feedback and let us know how you would like this to do. So for now, thank you for listening, and we hope to see you in the next one. Bye-bye.